Infrastructure is critically important. And for us, it's really about being able to manage risk and being able to control our outcomes. And so for us, when we look at expansion, it really is along the nodes where we already have infrastructure. That way, we're building on the relationships, we're building on the markets, we're building on the proprietary knowledge that we already have. We believe that it's very risky to helicopter into secondary and tertiary markets because you just don't have that infrastructure and that knowledge base and those relationships.
Ryan, welcome to the show.
Thank you.
Can you start by introducing yourself for our guests who haven't had an opportunity to meet you or don't know much about Graceada?
Yeah, I'm Ryan Swehla, co-CEO of Graceada Partners. We're a private equity real estate firm focused on secondary and tertiary markets.
Excellent. Well, I'm excited for this episode. You and I have had the opportunity to get to know each other over the last several years, and I'm fascinated by your strategy. Before we dive into that, let's spend a little bit of time. How'd you get into the commercial real estate business?
Yeah, so I majored in finance in undergraduate at Columbia University, worked at a hedge fund. And after staring at a screen, trading, multi-million dollars with the click of a button, I realized that might not be my calling, and was just ultimately gravitated toward real estate. I also at that time moved back to Modesto, California, and real estate was something that had drawn me. My business partner and I both started working for a owner of real estate, and I would say that really was transformative in learning how to handle multiple aspects of real estate, because we were doing brokering, leasing, construction management, asset management, property management. I mean, kind of the soup to nuts. And that was really formative before we actually started our venture.
So you grew up in Modesto. Where exactly is that for the folks on the line who may never have heard of the booming metropolis of Modesto?
Yeah, you may be looking on a map right now, but pretty much draw a line between San Francisco and Yosemite in the middle of California. That's Modesto. It's a metropolitan area, has about 500,000 people, which is large by most state standards, but by the state of California, that's a small town. And I'd say aspects of my past have been, a little bit contrarian, because most people, when they move out of a small town, I moved to New York City, went to Columbia, and that would pretty much be good riddance last time that we ever see the small community. And ultimately was drawn back. Part of that was family. But, I'd say the way I look at it today, and even when I shortly after I moved back, markets like that, in some senses, have greater opportunity than the large metropolitan areas, because, large metropolitan areas, there are a lot of people there, a lot of competition. And when you get out to kind of smaller areas, there's just a lot more opportunity. And I mean that even from a career growth standpoint and opportunities for being able to, move that next level in a person's career, not specifically speaking to real estate.
So growing up, it seems, before you got into commercial real estate, you went to Columbia, you worked at a hedge fund. I mean, what was on your mind growing up in Modesto? Did you always have it in your vision that you were going to leave for the big city and, the Wall Street career? To me, I don't know, I didn't grow up in a small town, but it doesn't seem obvious that you would know a lot about hedge funds growing up in Modesto, but maybe I'm wrong.
No, you're entirely right. Little spoiler. I actually got a brochure from Columbia when I was in high school, and I said, "Oh, cool, a school in New York." I actually didn't even know that it was an Ivy League. That's how that is more the typical kind of small town trajectory. And so, no, I didn't. I just had a vision of like, hey, it'd be cool to go to college in New York. At the end of the day, the finance track is interesting, because the joke when you graduate from Columbia is, are you going into investment banking, consulting, or other? That's it, And so I was in the engineering school, and ultimately I think I started in chemical engineering, something like that, but ultimately just realized engineering wasn't my thing. stayed in the engineering school, but they actually have this really cool track that is really kind of like analytical finance or, quantitative finance within the engineering school. It's under the industrial engineering department. And so I'd say that was really what got my interest peaked into finance, and ultimately drew me that direction.
Interesting. So you graduated and then you were out on the streets, if you will, and you ended up at a hedge fund. How long did that chapter last for you?
Yeah, it was about a year. I had spent 4 years in New York and then a year in San Francisco, where this hedge fund was, very reputable hedge fund. They were a leader in kind of tech investing in the day, Gruber McBain. And I was their sole analyst at the time. And it was a great experience. But ultimately, what ended up happening was kind of that drawback to my roots and to where I was from. And then also that ability to kind of start out in a career more aligned with what I wanted to do.
So when you moved back to Modesto, did you have a job? Did you know you were going to go work for this real estate, commercial real estate company, or did you kind of hit the ground and scratch your head and say, now what?
Uh, I'd say somewhere in between. So I did have a job, but I ultimately was looking for a good company to work under. So I worked for about 3 years before going into real estate. I worked for about 3 years in a manufacturing company. I was in inside sales for the company, but that was to learn to kind of gain more experience in the corporate or the business world. And then just a part I didn't mention is my business partner and I met in third grade on the playground in the elementary school. And so that's an important part of this story, because while I'm working at this manufacturing company, he's working somewhere else. We're hatching these plans around how are we going to get involved in real estate. And that really precipitated both he and I quitting what we were doing and going to work in under this guy that had a portfolio of real estate and getting involved. So there is a common thread of Joe and Ryan hatching plans. I will say, in our break room in our office today, there is a photograph of the third grade class with all the headshots of the little kids. And you've got Joe in third grade, Ryan in third grade. And next to that is a seventh grade suspension slip, because Joe and I actually got suspended for fighting each other at school. It was a really funny, typical young kid story, but it lives with us today in our firm. And that really is kind of the fabric of kind of who we are. I mean, even the fact that would be in the break room wall, at the office, it's just kind of who we are.
So you definitely check the box on, partners that have been together for a long time, right?
Yeah.
That's amazing.
We're more like brothers in the good way.
Yeah. Joe and Ryan hatching up plans. I love that. So when you got back to Modesto, you went to manufacturing, but I'm just curious, like, why real estate? I mean, I grew up in a real estate family. It's all we talked about, albeit not institutional. I remember at the dinner table, but I don't know, maybe did you grow up in a real estate family? And if not, like, how did you move from what was attractive to you about the asset class or the sector or the career?
Yeah, I mean, I would say it's a marrying of kind of my education and experience and where I was geographically, because there are, surprise, surprise, there are not high finance jobs in Modesto. And so as I was thinking about really continuing in the investment finance space, real estate was just kind of almost a natural conclusion to that. The other thing I'd say is, working in a hedge fund, I recognize that, being in the equity space or what I would call a more abstract investing space, I just wasn't drawn to it. The physical nature of real estate was always very tangible. And so I would say there was just kind of a draw to, if I'm going to continue, working in the investment space, real estate is kind of a natural byproduct of that. And I will say, as we talk a little more about kind of the firm history, it turned out to be a very fruitful decision, obviously. But in hindsight, I wouldn't say that when we were first making those decisions that we recognized what the opportunity set was ahead of us.
Yeah, I don't want to get too into the nitty gritty, but how did how does one who doesn't have a family background in real estate get connected to people who are in real estate in Modesto? Is it a small enough community where there's, a handful of operators who are based there and control a lot of the market? Or did you have to kind of go on a bit of a hunt to figure this out?
Yeah, I would say definitely a little more of the former. There are, you would kind of know who the real estate operators were in the area, and just because I've lived in the community a long time, we were able to connect up with those people and just start interviewing with them and talking with them about the industry, and then ultimately figuring out what our fit is in the industry. I'd say the harder progression is from where our firm started to being an actual institutional investment manager. That was a much more methodical and lengthy progression, which I can certainly speak to.
I think that's a perfect transition. So, you and Joe kick off the business. What year was that? I think it was right kind of coming out of the GFC. If I'm
December of 2008. So Bear Stearns had literally just collapsed, and someone decided it was a good time to start a business.
Why did you decide to start right then?
Yeah, market timing was not a factor. It really was that we were at the right point in our experience level that it made sense to actually go off on our own and start our own firm. And so it just happened to be, right as really at the beginning of the precipice of the GFC, which in retrospect was a tremendous learning opportunity. But we joked that like the first 5 years of the firm, we never knew what a good year looked like, because that's just the market that we were in, right? And we originally started by doing the things that would allow us to earn revenue as a startup firm. So that was brokerage, that was leasing, sale, and that was also property and asset management. So kind of right out of the gate, we were doing all those things initially, myself and Joe, and then as we grew the firm, and we ultimately grew to be a fairly good sized third party property and asset manager. I think we got to a team of probably about 15 people and managed about 2 million square feet. And at that point, that was really, I would say, a big shift in our firm, because we started in 2008. We actually bought our first property in 2013, so about 5 years later. And it was about 4 or 5 years later, after doing several individual syndications, where at that point we really had a property management and brokerage business, and we were just investing on the side. It was probably around 2017 that we made this conscious shift and said, we're going to take all that expertise and that experience, that resource, the team that we've built, and we're going to take it and we're going to turn it, and we're going to focus it solely on our assets. And so we selectively divested of third-party property and asset management as we grew our portfolio. And so, yeah, go ahead. I'd say that was the point where it was really that conscious effort of saying, this is where we are focused now, and being able to build off of the not only the resource and kind of the financial strength of already being an operating successful business, but also building on the expertise and the team that we had that was really about creating value for others for a fee, and then turning that and focusing it on creating value within our portfolio. That was a big, kind of a mental shift in our progression.
So creating value for your own portfolio makes a lot of sense, but it's not obvious to a lot of people that there's this parallel kind of investment manager profession career, which is actually quite different than the asset management business. Was there an economic driver, or like what was the motivation for making that pivot?
Yeah, so a couple things. I would say from a business standpoint, if we're the ones that are creating the value for owners, it was a logical jump to say, why are we simply in the fee business? Why are we simply receiving a fee to do all this hard work to create value, to grow NOI? We should be in the equity business. We should be taking our skills and taking our risk dollars, and applying it that direction. I'd say that was one. the other thing really was this slow realization of how fruitful of a market we happen to place ourselves in. So as we started, we had, I would say very early on, we had always operated at a very, I'd say a very high level or institutional level. We both my business partner and I have CPMs. We've gone through all the IRM courses. We have CCIMs, and just I'd say maybe because of the finance background that I had, we always operated at a more sophisticated level relative to our peers, even when we were doing third party property and asset management. And so when we started investing, seeing the ability to achieve returns, in a very, I don't know how to say this, but maybe just a very easy way, also made us start to realize that the markets that we're operating in really are underserved, underutilized markets, and non-institutional, you could say. And so to apply that institutional lens and approach in a market that is broadly not, that was the second part of that realization that we really want to be focusing our effort and our attention on that opportunity set.
So it's 2017. You make the pivot from being an asset manager to an investment manager. You've just described kind of some of the thought process behind that change. Now, bring us up to speed. What is Graceada today? And I'd like to just better understand, the size and scale of the business, some of the markets that you invest in, kind of your overall thesis, and then we'll move forward and unpack kind of the strategy side of things.
So just snapshot of the business as a whole. Today we're about 75 team members. We have about 600 million in assets, 650 million assets under management. We're vertically integrated. So part of the 75 team members are property management, on-site people, that sort of thing. And obviously you heard from our history that is really formative in who we are. So being the ability to have our actual staff on the ground at the properties adding value is a really important part of what we do, especially in the markets that we operate in. And then I'd just say from a senior management level, today we have a senior management team comprised of myself, my business partner, a CFO, CIO, COO, and then some very seasoned senior leadership below that. We've been very fortunate to attract a team that is composed of very institutional backgrounds. Our CFO came from John Hancock Farmland, where he had a $3 billion portfolio. Our COO came from a couple $1 billion real estate operating companies. And our CIO came from Shorenstein and Buzz Oates. So we've been fortunate to build out a pretty exceptional team right here in Modesto, California.
That's incredible. Were all these people already living in Modesto, or did they relocate for the opportunity? Because that was going to be one of my questions: is how do you attract talent in a relatively, narrow talent market?
It's really an interesting opportunity because it is a challenge and an opportunity. It's a challenge finding those right skill sets. But when you do, it's a very sticky combination because we've found the skill set we need, and that person's skill set is being, honored and valued in the market that we're in. And I would say it's a lot of different stories because, again, we are in Modesto. Modesto is about an hour and a half from the Bay Area. It's about an hour from Sacramento. And so we do have larger, skill sets to draw from. So some of the folks actually did locate. They already were located in or around the area. Maybe they were commuting into the Bay Area. Maybe they were commuting up to Sacramento, and now they had an ability not to. And then others, like our head of residential management, who came from Prometheus, she lives in kind of the East Bay area, and she does actually commute in 3 days a week. Our CIO lives in Sacramento. He comes in 3 days a week. So I would say that our ability to be nimble and responsive to the market for the talent pool is really important. When you're in a larger market, you kind of, to some degree, you have the ability to be a little bit more relaxed in how you approach talent. Being where we are, we definitely have to be very thoughtful. And sometimes that means hiring talent when we find them and before we technically need them. Sometimes that means, oh, I was connected with this person, circumstance, and we weren't ready to fully hire for that capacity, but we know we're going to be, and the person presented themselves, we're going to make that hire. So it's definitely put us in a much more proactive and thoughtful mindset as it relates to talent.
Interesting. So what is your strategy?
Yeah, so just boiling it down, our focus is secondary and tertiary markets of the Western United States. We do invest in two asset types, multi-tenant industrial and multifamily, and I can speak to those two asset types. But the broad concept is that these markets represent about $1.6 trillion of real estate just in industrial and multifamily. And for context, that's 4 times the size of the entire US self storage market. So when we think about, okay, is US self storage, is that an institutional asset class? Today it is, 20 years ago it wasn't. And so when we look at the collective market size of all of these smaller geographies, we see it as a tremendous opportunity. It is just a matter of how does one appropriately approach those markets differently than they would in primary markets. The two asset types that we focus on, multi-tenant industrial and multifamily, primary reason for that, we've actually had, I would say, a winnowing process in the asset types that we focus on. We came from a background where we were literally managing and adding value across all 4 of the main food groups: retail, office, industrial, multifamily. And we've invested across all 4 of those asset types. But over time, we've recognized the value of sticking to these two, not as much for the macro trend. We know the macro trends in those asset types. I don't need to speak to that as much. But the bigger part of it for us is we're very risk averse managers. And for us, our primary value add is we're buying from a longtime private owner who has owned the property for, decades sometimes. And the in-place rents are 15 to 40% below current market. So all we're doing is that mark to market value add. And so when you work in these two asset types, they have constant lease rollover and you have an ability to very quickly grow NOI. You also have lower kind of ongoing TI and CapEx costs relative to office or retail. So I'd say those are the two main reasons that we focus on those two asset types.
And you mentioned secondary and tertiary markets. How would you define those?
Broadly speaking, tertiary, we would say, is between 500,000 and 1 million people, or maybe 1.5 million. Secondary is kind of, 1.5 million up to 4.5 million. So secondary markets in the Western US would be like Portland, Denver, Sacramento, Phoenix. Tertiary markets would be places like Modesto, like Salt Lake City, like Boise, like Bakersfield. And I think an important thing to touch on here is when people hear the words secondary and tertiary markets, sometimes there's kind of an immediate reaction or perception of what that means. These are broadly diverse economies. Each of these cities, when you look at the GDP pie chart by industry group, it's a very diversified economy. So what we're not talking about is kind of like 1 mil towns or, very small towns that are dependent on one particular industry, and that industry changes and it changes the economy. These are, again, 500,000 and above population, and they're just broadly diversified economies.
So what is, unique about your strategy, I guess? I mean, I know what is unique about it, but I get, why wouldn't any institutional manager be able to enter these markets and kind of run that same playbook, which is, buy from local mom and pops, increase rents, drive NOI growth? Seems like a very logical risk off strategy, but clearly I don't hear about, Modesto or Fresno or some of these markets as often as we're talking about it on this podcast.
Yeah, absolutely. You've probably heard these words more often on this podcast than anywhere else. So what I would say is fundamentally, these are inefficient markets by their definition. And inefficient markets, broadly speaking, in an inefficient market, an investor has the ability to achieve higher returns without incurring the same amount of risk. One could argue whether these markets quantify for or qualify for that, but inefficient markets are where you really have information arbitrage. You have the ability to get deal flow and to execute on that deal flow in ways that are harder in more efficient markets. Just for example, when we're acquiring, we're never operating in a bidded environment where we're, participating in a marketed process. This is when we buy, it's from brokers that they heard that the patriarch passed away and the kids might want to liquidate, or they know that this family's in some generational planning. And so it's a much more inefficient manner, and it takes being on the ground in those markets to earn the right to have that deal flow. So it's in primary markets, because they're more efficient by their nature, it's very much a bidded, transparent process, relatively speaking. And so it's much easier for a group to helicopter into that market. There are more third-party reports, there's more data available, there's more information availability. And so it's much easier for an institution to say, hey, I want to be in Los Angeles and I don't currently invest there. I'm going to come into that market and I'm going to build opportunity, because everyone's operating kind of under similar paradigms. When you come into these smaller markets, it's much harder to be able to identify opportunities, to be able to execute on them, even down to, you look at the quality of the third-party managers in these markets, and they're very mom and pop. They're very non-institutional. So just the infrastructure needed to execute in these markets is very different. And that's, for us, again, having started in Modesto and kind of grown out from there, we've understood that implicitly and we've built our infrastructure around that. So I'm not saying that it's impossible to replicate. Absolutely, if a group put their focus on it, they could, but it's a much harder process to build out that infrastructure to execute in these more granular markets.
What does that infrastructure look like?
Yeah, so two things I'd say, or three things really, which is people. So having people on the ground in those markets, because now you've got a feedback loop. So just as an example, in a given market, Bakersfield, actually, I'll use that as a good example. We bought our first asset there. All of a sudden, we were seeing rent much stronger than any of the limited third-party data sources were demonstrating, but that was our real lived experience. And now all of a sudden, we can take that and we can use that on future underwriting. So I'd say people. The other thing is relationships. So relationships goes down to both the broker relationships and the vendor relationships in those markets, both of which are great information sources. And obviously the brokers are, pipeline sources as well. So developing the trust in the markets that when they've got some, circumstance, some off market thing that they think might be a thing or it might not, we're the ones that they call instead of another group. And then the last thing is just proprietary data. And that proprietary data comes from, again, that lived experience in each of these markets. And I'd say those are really kind of the three ingredients: is data, relationships, and people in the markets.
What surprised you the most? I mean, clearly you understand the benefits of smaller markets, having grown up in one and returned to one. And, you've got this thesis that you've been executing on for, many years now. But what's been most surprising as you've expanded the platform about how these markets operate?
Couple things. And they hit on probably the two main objections that people have when they think of secondary and tertiary markets, and that is perception of liquidity and how these markets performed from an economic standpoint. On the perception of liquidity, it's been fascinating to see our real world experience through 2020 and through 2023. Obviously, through the GFC, we were a third party property and asset manager, but we still lived through that and we saw how assets performed during that time. But on the liquidity front, it's fascinating. And we actually recently did some research here because we were looking at what does liquidity look like, transaction volume over time in these smaller markets versus larger markets. And we actually broke it out by asset size. And we found some really fascinating information, which is that at the smaller asset size, whether you're in a primary market or a secondary, tertiary market, at the smaller asset size, it's way more liquid. The transaction volume it has like a quarter of the volatility of what we would consider to be institutional asset sizes. So we looked at, I think, 40 million and above, and 40 million and below, down to 1 million. And in that below 40 million segment, way more stable deal flow, way more stable volatility. And it's really, so what's interesting is the institutional markets, the larger asset size, those are the markets that are less liquid and more volatile as markets change. I'd say that was a huge eye opener. And what caused us to look at that was that in 2023, we sold 3 assets at exceptional returns, and we bought 4 or 5 assets. And I would say that was the year 2023 will probably be on record as the lowest transaction volume year in a decade. And the why of that is that in these markets, it's more private capital than institutional capital. And private capital does not have the same motivations as institutional. Institutional is sophisticated. So when the market changes, institutional capital steps back and they say, we're not transacting. Private capital has external motivations to the market. It's patriarch died, it's liquidity, it's I have a 1031 exchange. So there are all these motivators that would still make them transact in a otherwise, challenging market. So I would say liquidity was a real eye opener, and seeing how that happened, that performed through 2023. The second thing is kind of the economic vibrance of these markets. We work in only growing markets, and that's pretty easy to say because if you close your eyes and you point anywhere in the Western United States, except maybe San Francisco and LA for the last few years, but other than that, you point anywhere else in the Western US, and these are all growing markets. And so I would say we always operated in these markets, so that this is kind of, in a sense, all that we knew. But seeing it through the pandemic, obviously there has been an upswing in interest in these smaller markets. We are already seeing that tail off. So that's not a seismic shift, but it's tailing off right back into that long-term trend line of positive population growth. So it's kind of like we had a spurt through the pandemic, and now we're just getting right back to that long-term trend line of population growth.
I heard you reference, I think on your podcast, the way that you think about market expansion is by following a similar strategy that In-N-Out has used. Can you explain that? And by the way, for our listeners who don't know In-N-Out because they don't live in the western half of the U.S., maybe you can talk about why this is such a interesting and important metaphor for all of us.
Well, I think most people know In-N-Out is kind of like a cult classic. I know when I went off to college, one of the first things I would do when I came back to the West Coast was go get an In-N-Out burger. So it's very much the quintessential, I'd say healthy, but not really. It's natural ingredients, but it's fast food. At the end of the day, it's burgers. But one of the things that people noticed about In-N-Out is, you'd eat it, you'd say it's amazing, and then you'd go back to Nashville or wherever you're from, and you're like, why don't they have an In-N-Out there? Why don't they have an In-N-Out in Dallas? I think they maybe have gotten there now, and In-N-Out was very disciplined about saying, we will only expand as we go. We will not hopscotch into a market, no matter how much opportunity that market represents. And the reason fundamentally is because they have infrastructure and efficiency, and they're more focused on maintaining their efficiency, their cost structure. In-N-Out's very affordable, relatively speaking. They're more focused on that than they are on the opportunity set of hopscotching into a new market. We view it kind of the same way as In-N-Out, that infrastructure is critically important. And for us, it's really about being able to manage risk and being able to control our outcomes. And so for us, when we look at expansion, it really is along the nodes where we already have infrastructure. That way we're building on the relationships, we're building on the markets, we're building on the proprietary knowledge that we already have. We believe that it's very risky to helicopter into secondary and tertiary markets because you just don't have that infrastructure and that knowledge base and those relationships. And so we do look at the 3 inland north-south interstates in the United States as kind of our lifelines. That's the I-15 in Utah, I-5 in California, Oregon, Washington, I-25 in Colorado, New Mexico, that area. And so we build along those. We have infrastructure along each of those interstates. And our expansion plan, much like In and Out, is the adjacent market to us, moving along those market adjacencies. So we don't as much look at, hey, this market exhibits some compelling opportunities. I'm going to helicopter into that market. We view that as risk. Instead, we look at it very much as kind of a slow expansion process along the nodes where we operate.
That's fascinating. And so what does that addressable market look like? And is it, as an institutional investment manager, you mentioned the size of the multi and industrial markets. I think you said 1.6 trillion, if I'm not mistaken. I mean, is that the right way to think about market depth? Because that ties into the sentiment around, or the perceived sentiment around, illiquidity.
Yeah, absolutely. Yeah, and that is exactly it. Is we kind of, when we started looking at the broader geography where we were investing and where we were growing, we looked at what is that market opportunity set, and the 1.6 trillion number, again, that's just industrial and multifamily in the Western United States. And for context, it's 4 times the size of the US self storage market. And the reason I mention that is because clearly US self-storage has become has had the ability to be a large enough asset size that institutions have deployed into it. And so we view these markets as being very similar. I would also say it's similar to self-storage in this sense. 15, 20 years ago, and for those who are in the business at the time, you would remember this, but institutions, when self-storage, people started thinking about self-storage or mobile home parks or single family rentals, whatever it is. When those first movers started investing in that space, what did institutions say? Market's too small, it's too disaggregated, it's mom and pop, it's not sophisticated, it's illiquid, kind of the same litany of reasons with secondary and tertiary markets. And then, of course, what happened over the 15 or 20 years, it's now kind of a regular part of that. And to think that a market that represents, just in our asset types, $1.6 trillion, to think that it won't become part of the institutional allocation, I think at this point is foolhardy, because it just represents such a large market. So then the question is simply how, not if. And that's really how we view the world.
And to some extent, correct me if I'm wrong, but it seems like the businesses in these communities are the lifeblood of a lot of the, American economy. And you mentioned previously kind of in-migration and population growth into second and tertiary cities. I'm curious, like, what are you seeing from your teams on the ground that's happening in these markets right now? And what does that tell us about the relative health or challenges that our broader economy faces? Because, what's happening in New York or San Francisco or LA is one thing, but what's happening in Fresno or Modesto or Bakersfield is another.
Yeah, absolutely. And that's an interesting one, because recently we've started to look at some of the data related to rent growth and values and cap rates and GDP of these various markets. And in many ways, these markets have, over the last 20 years, have performed better than their primary counterparts. And that's just a function of, a big function of that is positive population growth, right? Real estate is driven by demand. And if you've constantly got additional demand, it helps to cure over oversupply. And you'll see even in the markets like Denver or Salt Lake that clearly had some momentary oversupply in multifamily recently. Already they're curing right out of that. Denver, I think, just had 4 months of positive rent growth. So that's not to say that, the problem is solved, but the point being that when you've got positive population growth, it always is a tailwind to whatever strategy you're focused on. And then, as I mentioned earlier, these are broadly diversified economies. No one industry sector is more than 15% of a given economy. So there's just not, obviously, when you have a broad market downturn, everybody is affected, but that's primary markets and that's secondary markets. And interestingly, in some cases, the secondary and tertiary markets have recovered better than primary markets.
So we've talked a lot about the benefits. Now, what's not working? It can't all be rosy.
Yeah.
There's got to be downside of operating in these markets. So what's the dirty truths behind being a first mover in some of these markets?
Infrastructure, if absolutely infrastructure. I would say that that is the biggest thing. As we slowly, methodically expand into adjacent markets along I-5, I-15, I-25, it's building that infrastructure. And actually, stepping back, when we first built the infrastructure on I-15 and I-25, those are jumps, into Utah, into Colorado, and that was a big learning curve. And it's getting entrenched in the market, and it doesn't happen overnight. So you buy an asset, and first of all, we probably spent 2 years underwriting assets and evaluating assets before we bought our first asset. But you buy your first asset, and now you've got that feedback loop, and you have that ability to grow and develop your relationships off of that. So I would say those were the biggest shifts. But as we expand into adjacent markets, there's still that learning curve of the nuance of that market and how it operates. The other thing is that we do view today we're in, I think, 10 markets. And we do view each of those markets a little bit like levers. With the two asset types, we view like levers, and then the markets we view like levers. So we will never move out of a market completely, because we believe that having that infrastructure is a proprietary value. And so we'll never move out of a market. But just as example, I mentioned Salt Lake. Right now, we're not underwriting multifamily in Salt Lake because we're seeing where the market settles out, and we're waiting till we see pricing that looks appealing. Meanwhile, industrial continues to be strong there, and so we are acquiring another industrial asset right now in the Utah market. So I would say, knowing which levers to pull and where and timing, I'd say that's another aspect of it.
And do you envision yourself ever expanding further east, or are you going to stay kind of I-25 corridor
Not
and
in,
west?
yeah. I mean, I wouldn't say no, but I would say that's a long ways off. I think at this point we see a huge opportunity set in building along the infrastructure that we've already built. So really, at this point, is a north-south movement along those lines. And who knows? 10 years down the road, if we're fully north south, then we can look at other opportunities. But we definitely view Western United States, those three corridors, secondary, tertiary markets, as our kind of our strategy and our focus. And in that strategy space, we do view ourselves a little bit like our goal is to be the Kleenex, right? Is to be the brand associated with that strategy, which is a good and bad, right? It also is an education process, because we're talking about a strategy that is starting to gain institutional traction, but is not broadly accepted. And so that's a downside. It means that education process is a big component of what we do. Actually, I was at the SACRS conference last week, State of California, county retirement plans, and they had a Shark Tank competition, which is great. I've never done that before, but they thought it would be just kind of a fun, lighthearted, groups get up, give a 3-minute pitch, and you've got, three institutional senior consultants as the sharks kind of judging. And we went up against some name brand firms and some very popular strategies. And we won best overall private market strategy. And so to see some of the resonance or the appreciation of the opportunity in the market is really, really powerful.
Wow, that's awesome. And to get that acknowledgement from investment consultants is no small feat, because we know that
Yeah,
they see it all. So congratulations to you
they
on
do.
that.
Thanks.
So let's spend the last few minutes. You mentioned something early on that I'm curious about. You kind of made this decision to move to an investment manager, and you raise and manage capital on behalf of institutions, which is different than individuals. You mentioned that journey, maybe, I don't know how linear it was, but as you look back on the last kind of 8 to 10 years, what has surprised you most, or kind of what have you learned as a emerging manager in institutional investment management? Because a lot of our listeners have a little bit of institutional capital, or maybe thinking about making this transition. So I'm curious to know, through your lived experience, what you can share.
Yeah, and by the way, I would say Alliance Global, Heather Border, Jen Stevens were really instrumental in our progression. So I do want to give a little bit of a shout out to them. So we started really as friends and family, right? We were just kind of on the side, found a deal, got some friends and family together, and then we made this progression. And what I would say for folks that are looking at that or they're partway through that progression is it's much longer than you think, and it takes a lot more infrastructure than you think. It really, if I look at how we are as a firm today compared to how we were 5 or 6 years ago, it's just almost night and day in terms of how our internal controls, our processes, how we do things, how we view things. All of that is just the table stakes to be able to compete in the institutional world. The second thing that I would say is one thing that we found surprising and in our case edifying is that really the institutional world is constant learners. Every LP that I've ever met are these continual learners who are always trying to aggregate and digest a lot of information and data. And so for us and our strategy, because it requires this education process, that's been really edifying to find institutions that are just literally kind of gobbling up the data and the analysis and kind of what we're seeing in the markets. So what I would also say is just that education process is so critical. People think of it as a marketing or a sales process. And in some sense, it's really not. That's a component of it, but a very large component of it really is that education process and being a value leader and being able to provide value to the institutional world. And in some cases, we've been providing value with some LPs for 3-4 years, and we've have not received dollars from them, but we have a great relationship, and we anticipate that at some point in the future when their allocation aligns, we'll do something.
Yeah, well, I think that's great, and I think that's the right long-term, perspective in terms of how to build and maintain institutional capital relationships, and having the privilege of having a lot of these individuals who make allocation decisions as friends and professional acquaintances. I know nobody likes to be pitched, and everybody definitely wants to learn, and they need a safe space to do that. So, as you look forward over the next few years, we're recording this in May of 2024. Kind of, what are like the top 2 or 3 business priorities that you're focused on the go forward plan?
I would say number one, continuing to build out the infrastructure. So we will methodically expand to adjacent markets, 1 or 2 a year, as we slowly grow into this space that we view to be our kind of market space. The other thing is just continuing to build out the team. We've been very fortunate because our roster of senior management and next level down management is just top notch and frankly oversized in terms of their raw horsepower relative to where we are today. So we really are built to be able to scale we'll probably cross $1 billion in AUM, if not next year, then the beginning of the following year. And we anticipate continuing to grow from there. But that next level down is really that associate level, and that analyst level is an area that we're very focused on finding those next right hires, because as you scale, if the leadership team is already built to be able to handle a fair amount of scale, you still have to build that infrastructure below. And then the last thing that I'd say is really, and we haven't spoken to this on this podcast, but really continuing to live our core values. So we are, born and bred in a secondary, tertiary market, and we believe that that's part of our DNA. I would say our ethos is generally, where we're from is called like the Midwest to California in some senses. And so it's very much that kind of, the positive side of that Midwest ethos. And we have 5 core values, and our number 1 core value, or our first core value listed, is positive, caring, and humble. And I think those words are not often associated with the term real estate private equity. And we believe that that's a key part of who we are. We don't handle ego. You have to check your ego at the door. If you're a high ego person, but you're a top performer, you're just not meant for our company. And so staying true to those core values as we grow and ensuring that we are hiring, we're promoting, and we're firing based on our core values is just a really important part as we scale. Because as you know, as you scale an organization, it's hard to retain that culture. And unless you're conscious about retaining it, it has an ability to drift away.
Well, I think that's a perfect place to leave the conversation. You're the first person I believe to talk about values on our podcast, and it's something that's very near and dear to our heart at Juniper Square as well. And we know that it's not just about talking the talk, but walking the walk. So, Ryan, I appreciate you joining me today. It's great to learn more about your story and the story of Graceada, and look forward to continuing to follow the journey going forward.
Sounds great. Thank you.